Everybody, this is Rob Keenes with the Freedom Report. We are recording this on the 23rd of January, 2025. It's a Thursday. One more day left in the week, which is good for me. I've been a little bit under the weather, so this week couldn't end any sooner. I'm bringing back a familiar guest. Is on the program when I was out at Bitcoin Nashville earlier this summer when Trump gave that big speech about the Bitcoin reserve and all that kind of stuff was going on. It's Mel Mattison. He's written a book, and he's been a long time analyst and trader on Wall Street. And I wanted to bring you up to date on what we talked about last time. And then he is going to provide some updated information on his thesis and theory about where the world could be moving to, which I think you're going to find really fascinating. Now, last time we talked a lot about the history of the dollar, the BIS, Nazi Germany, and some other topics about the markets. And so we'll talk a little bit about the markets, but really, as we've seen the world sort of move, viewers of my channel know that I've talked about consolidations and changes in commodity networks, currency networks, geopolitical realignment, that type of thing. We don't just talk gold, silver. We really talk about a lot. The BIS and sort of how all this plays together. It's been really confusing for people because the model, I think a lot of us thought a year or two ago, really hasn't kind of panned out the way we thought. And I think Mel may have a bit of a longer term picture of what's going on that may help us really deal and grapple with the events that we're seeing today and put them in a context which makes more sense. In other words, what we're going to try to do is alleviate some of your confusion and maybe give you a working model that you can work with, not only so you understand what's going on in the world geopolitically, but also from an investment perspective, where you may want to kind of move to given the changing structure of the world. Did I do a good job of describing that, Mel?
Yeah, I think that's perfect.
All right, awesome. So we'll just jump right into it. Let's real quick, just give a picture of the here and now, and then you can get into your ideas. What for you immediately in 2024 and 25 really has changed, and how that kind of leads you into, what we were talking about before in the thesis you're going to reveal to our viewers today?
Yeah, well, I think, there's a broader thesis of what's going on, and I think that really is a multi-decade process that began probably around 2017 when Trump came into office the first time. And we've seen that thesis kind of develop and play out, whether we're talking about under Biden or now with the new Trump administration. But then on the other hand, there's also nuances and differences in how the thesis, gets implemented, the specifics of the direction of travel that we've been in for a number of years now, and that I think is going to accelerate and continue. And briefly, what that thesis is, most broadly speaking, is it's a complete, geopolitical repositioning from an internationalist post-World War II order to what I call a post-globalist order, where traditional alignment, say a very strong European U.S. alignment, these are going to start to break down. A pivot from a concern really about, say, Europe to more concerns geopolitically around Asia. A reassertion of dominance in the Western Hemisphere, where the U.S. kind of let the Monroe Doctrine slide a little bit in that post-Cold War unipolar moment, if you want to call it, where U.S. dominance was not really being threatened by a peer competitor like China. And now we're starting to see, hey, we need to shore up Panama or Greenland or get stronger ties and resource ties with Canada. And so I think when you look at it through this broader spectrum or lens of a total realignment really to a war footing, an economic war footing. And I think that's really the situation that we're in, is an economic war. I think if we were not in a nuclear world, there'd already be a hot war, with perhaps U.S., Russia, perhaps with China. I think that, the nuclear threat that hangs over the world means you have to operate differently from a defense and a geostrategic and a State Department perspective. And so that's really what I see playing out big picture. And then that turns into ramifications for the financial markets, with things like the dollar, the bond market. And I think ultimately, not to jump too ahead, and we can get into the details of how this would all work, but it also, because of this war footing, it puts us back more in a situation we were in the 1940s, where the financial markets are subservient to geopolitical concerns of the nation state. And that can mean things like a abandonment of the 1951 Fed Treasury Accord, which really returned independence to the Federal Reserve after the World War II period, when the Fed was at the beck and call of Treasury, when we had 10-year interest rates capped at 2.5%. We had the short end at 3/8. So we had yield curve control, we had price controls, we had all these sorts of things that are kind of anathema and kind of out of consensus, out of the Overton window for discussion for the last, call it 7 or 8 decades. And I think these are now going to come back, and we're going to have discussions about how independent, should the Federal Reserve be, how subordinate should things like the bond market and treasury market be to geopolitical concerns, and that these are going to have major investment ramifications as we go forward in these next few years.
Yeah, you did a lot there, and so I kind of want to put like a little marker here in the video for people. So what you're talking about is literally a changing of focus from sort of a free central bank era into maybe more of a government stepping in, because government is now looking at dealing with other things. In other words, we were sort of in our heyday for a long time. That free monetary policy works when you're not engaged in a bunch of geopolitical conflicts. And the geopolitical conflicts may have manifested actually from, and this is me sort of injecting my own thought here, it may have manifested from that central banking era. Not that it's all the Fed's fault, because you have to look at the government too. The government and the Fed, just like the kings and the money changers of old, the goldsmiths, have to collude together into overspend, into fractionally reserve and profligate spending and things. And now it's really maybe the government's coming back, reining that in, saying, oh, we went a bit too far. And this has caused all these other geopolitical problems. Now we may need to go into a little bit more of a defensive or maybe a state-run defensive posture. Would that be a good way to look at it? Or is there more to it than that?
No, I think that's true. And I think it does need to be, I think the big parties are on board with this. So I think, it's not surprising that the big banks are trading at record highs. So this taking away of, say, financial independence from the Federal Reserve does not necessarily mean bad things for shareholders of JP Morgan or Goldman Sachs or Citigroup. Indeed, it might mean the exact opposite. And I think that it's really a partnership, in the sense that, exactly, let's say in the 1980s, where there was a little bit more independence, when U.S. debt to GDP levels were closer to 30% instead of 120%, it was possible to insert someone like Volcker in there and say, we need to tame inflation. If that puts the U.S. into recession, it's no big deal. We're not facing a existential threat from the Soviet Union at this time. We basically can handle higher interest rates because the government deficits are relatively under control compared to what they are now. The net interest expense that the government is paying, if they have to pay 7, 8, 9, 10% on their bonds, they can handle that. We can't handle that right now, right? So, the monthly Treasury report came out last week, which is, it's a nice PDF document created every month by the Treasury with all the receipts and outlays for the month. And we just finished the first quarter of fiscal year 2025 with a $711 billion deficit, which, annualized is something closer to 3 trillion. And if you compare it year over year to where we were at the end of December 2023, we were at 510 billion. So that's a 39% increase, from 500 to basically over $700 billion in deficit in just the first 3 months of this year. And so, and you look at the interest expense, and of course it's bigger than defense spending. And so you get to the situation where literally the state's survival is threatened with, I would say, something like a 7% 10-year Treasury, because
It's an existential crisis at this point. It's not just a paper crisis. We're looking at this could be really, really bad in a rising interest rate environment.
Exactly. And when you're dealing with, excuse me, existential threats, and I think the main one is China. And I think, they just launched a new frigate yesterday. They're building a blue water navy that can travel around the world in the way that England used to have when they were the dominant world power, in the way that the United States put in place in the early part of the 20th century under Teddy Roosevelt with the Great White Fleet, which really ushered in this era of American imperialism. So we're seeing this buildup in China, which is very reminiscent of what we saw, say, with Japan in the 1920s and 30s, where you can go back and you can look when, I think it was when FDR was appointed Secretary of the Navy, his uncle Teddy Roosevelt, and this was in like 1914 or 1913, was warning him, watch out for Japan. They're growing. We see the signs. As you take over the United States Navy, be aware. This was 20 years or more, 25 years or more before Pearl Harbor, and so these things play out over like decades, but they're ramping up. And like I said, I think it really started around 2017, where the whole mindset of we can bring China into the World Trade Organization, we can utilize them as a manufacturing base, they'll buy our treasury bonds, and this will help cheap goods proliferate around the globe, and we can focus on things like financial services and accounting in the United States, and everybody's going to get along, and this is just going to be a hunky-dory type of a time. I think those naive hopes are falling away, and I think they've already fallen away within the defense and state establishment. And so, you're not getting pushback on some of these things that Trump is saying as much as you would have 10 years ago if these ideas were brought up. And what you did see as well, last thing I'll add, is you saw this philosophy actually being attempted to being carried out even under the Biden administration, but under more socialist clothes or whatever. So, for example, independence in chips instead of public-private partnerships, like with AI. Trump just announced, $500 billion. There's discussion, do they have the money or not? But we're going to really fast track this. We're not going to worry about environmental concerns. We're going to get all the permits. And then you saw with Biden, you saw the CHIPS Act, like we're going to approve government spending of tens of billions of dollars, and so these are the types of things. There's the debate about Nippon Steel taking over U.S. Steel. So these are the types of things that I don't think these discussions or things would have been happening 10, 15 years ago. And I think we're going to see more of these types of things occur, which are essentially putting the U.S. on an economic war footing. And that doesn't mean that, if it's bad for multinational corporations, that will be subservient. If it's bad for the international banking cartel, that will be subservient. But the corporations and the banking cartels are figuring out ways, because they're smart people, how to make their money in this new order. And that's what we're seeing happen with the banks and with the tech oligarchs as well.
Yeah, that's a good point. And China really is rising. And I know I've talked about the 250-year nation-state cycle theory, which is basically 3 conjugative wave economic cycles. And that nation-states go through that. They don't disappear and fall off the planet, but they go through build up in waves and then they come down. And it seems as though China's on its way up, even though it has economic problems. The West is on its way down. Or maybe you could say BRICS is on its way up. And the Western Alliance, the Blue Dot Network, however you want to classify it, is going through its winter season. And that could be driving a lot of this. Do you think that whatever the United States is doing in the short term is going to be effective, not maybe against the BRICS, but just in its own existence, its own ability to kind of cope with its own problems? Because it seems to me the United States worries a lot about the rest of the world. Maybe we just need to worry about ourselves for a while, because there's a lot of economic pain and suffering, it seems to be coming. And the other thing is, I don't think we want to poke China for about 5,000 reasons. If they're building Blue Water Navy, which they are, they've got their nuclear missiles, which they do. They've got hypersonics, which they do. That's the military side. But you've also got this massive trade network, covers 72% of the world's economies. You've got them having more gold than we do. You've got them, their even though their economy's having issues, they're clearly on the way up, right? And they process rare earths, and we can't. There are many reasons why we don't want to go to Russia and China and poke the bear right now. Should we turn more inward and kind of focus on ourselves, or do you see that in this model of what's going on?
Well, I definitely think that we should. I think that makes sense, and I think we need to shore up, number one, the United States itself domestically, and then also, what is going on in our traditional neck of the woods, the Western Hemisphere here. I mentioned that we kind of let the Monroe Doctrine slide. This was put in place by President Monroe, that basically said foreign power interference in the Western Hemisphere will not be tolerated. And so I think that's the number one thing to do, just like it would be with an individual. You got to get your own house in order first before you can go out into the world and really do things that you might want to do. Now, we might not want to do these things. There's an argument to be made for saying, hey, in the long run, what China probably really wants is to be a hegemon in Asia, the way we are in the Western Hemisphere. Regarding Europe, I think that there's a whole shift there going on as well, which we could get into later. But I think, to your point, that taking care of things at home first is needs to be the number one priority. And I think, with immigration and the closing of the border and trying to essentially, bring back some of the decline that we've seen in our major cities. I mean, I think we're kind of talking about two different things here. We're talking about the foreign policy and what's going on more broadly, and then the domestic policy, and the two are interrelated, but they are in some ways different. And we've seen our major cities, the infrastructure crumble. I lived in California for 10 years, and I hadn't really been back there in a while. This was between, call it 1999 and 2008. And, I'd been back once in a while, but I was back there a couple of weeks ago. And to me, it was just really clear that state has declined. Whether I was looking at the roads, the state of the interstates, the just, the public infrastructure. And so what we need to do is we need to get those things straightened out and figured out. And we're seeing a shift there. And then we can also try to walk and chew gum at the same time and do some of these things more broadly international. But I do think they need to have that focus of shoring up national security and national interests, not attempting to try to be a global hegemon and just dominate the world, unilaterally, but to say, what are our main interests? How do we protect the American people? How do we provide a high standard of living for future generations, and then not be threatened by outside forces in the world? But inevitably, what tends to happen is, despite those best intentions, these globalist networks that have been entrenched over the last 7 decades tend to have, puppet strings that they're able to pull domestically and bring people into things because, Starbucks doesn't want to lose its, 5,000, 10,000 stores in China or what have you. And so it gets complicated and not very easy to untangle. But I do think you're right. In an ideal world, that's what we should be focused on. And, Starbucks, share price collapses, so be it. But, realistically, a lot of the power behind the scenes and the money does tend to ultimately push us into a more extroverted posture than I think the American people generally would like to be in.
So moving on, I guess, a little bit from the geopolitical and the trade, from an investment standpoint, what do you see changing the investment landscape for people, and what should they be considering?
Well, I think just one thing to add to with China, because you did mention they have their own problems, and they do certainly have their own problems, and a lot has been made about the Chinese housing market. But the Chinese housing market is not it's not the same type of a situation here where we had a housing collapse and then the banks go under. China has essentially state control of the banks, and yes, there were a lot of banks that made a lot of loans that are more or less worthless regarding the housing sector. But Xi and the CCP are able to essentially just go in there, say to the banks, you're going to do a good bank, bad bank. You're gonna separate into two different entities. One of them is going to take all those bad loans. The other one's going to take the good loans. If you need to be recapitalized, you'll be recapitalized. And there's no discussions about, are we nationalizing the banking system? The type of discussions that came up here during the financial crisis. And what we have seen China do is completely move from making just, mindless widget type stuff to very high caliber appliances, very high caliber electric vehicles. China dominates the auto market now. I mean, 10, 15 years ago, China was the place you went to get all the crap that you buy at Walmart for 99 cents. Now they're making extremely high end, high margin products, and they're not as concerned about selling to the United States as they used to be. Because, if you go to other places in the world, whether it's Europe, whether it's South America, you see a lot of Chinese vehicles on the road. You're seeing, other parts of Asia also import these goods from China, where they used to get them from Japan or the United States or perhaps even Germany. So China is forging ahead, and they're, in this process. I don't think it's a coincidence that we saw U.S. yields spike as Chinese yields fell in the bond market. I think, as Trump was coming into office, I think that it's very clear that Chinese banks and other institutions that hold treasuries were selling treasuries and switching them out for Chinese bonds, because they don't want to be in a situation where, like Russia, where these assets can be seized. And so this whole process of moving away from treasuries, away from the dollar, it's continuing, it's accelerating. They're forging new economic alliances, the Belt and Road Initiative, all of that. And they don't really care that much anymore about, importing to the US. And so the tariff threat that we think we have this huge stick to China to say I think they're preparing, for a world where the US is not a huge trading partner. And I think Russia, it's the same thing with, when we hit them with all those sanctions and everybody predicted the Russian economy to collapse, and that hasn't happened at all either. And so I think both sides know what's going on. I think Russia and China know they're already moving to this new world order, post-globalist order. They're on one side of it. The US knows they're on the other. And I think that's why we weaponized the dollar, because we said the game is up. They're already selling treasuries and buying gold. So, might as well seize treasuries while we still can. I don't think that weaponizing the dollar actually sped up the process that much. I think it was already ongoing. Maybe it sped it up just a little bit, but the process was well on its way. So I think that's the broader economic context that we're seeing. And we're seeing it, like I said, begin to play out here in the United States, where if we get into a situation where, let's say, treasury yields really do continue to climb, and I think that they will. I think we're just in a bit of a counter trend move here. That as they get closer to 5% on the 10-year and perhaps go above, the U.S. will realize we cannot allow a major recession to happen. This is too critical of a time geopolitically, and we need to do whatever is necessary to halt that slide. And that's where you have these very important comments that Scott Bessent made at the Manhattan Institute 6 or 7 months ago, where he said he envisioned a complete global reshaping, a new Bretton Woods occurring in the next 4 years, and he wanted to be a part of it. And so I think this is where all of these things that people think are almost impossible, like questioning Fed independence, yield curve control, whether overt or covert, are probably going to occur within the next 6 to 12 months, because I don't think it's going to take, 3 years for some of this stuff to start to become consequential, like yields.
Yeah, and talking about yields in the economy, the U.S. is facing, because of all the debt load at every level, a slowly decelerating economy. Certainly, you can see it in consumer spending. Consumers have cut back on credit card usage, whether or not they're maxed out on what they can afford to service, which is indicated by credit card defaults and auto defaults. I also think that consumers are trying desperately in the not the best job environment to reduce their expenditures in light of inflation they suffered the last few years since 2020. And it just seems to me that it's going to be very difficult for the U.S. to grow their way out. And here comes Trump in saying, we're going to grow our way out. We're going to increase energy and all those things. And yes, it's kind of like you can push on it. Do you think these policies, and let's forget the tariffs for a moment, because I suspect, much like David Hunter, who was on the program a few days ago, said that the Trump will claim tariffs, but they won't be as effective and he won't use them as much. Okay, so it'll be less than the rhetoric. But beyond tariffs, do you think what Trump is trying to do by releasing regulation, increasing investment in energy, speeding up some of these energy developments, also getting into AI and trying to get more involved in the tech side of the economy to compete with a lot of Asian nations, by the way. Do you think this is enough to kind of push America into a growth phase? I kind of feel like we still got to clean out the debt, but what do you think is the outcome of this?
Yes, I think that the broad two-pronged approach to kind of get not just the U.S. but most Western nations out of this death spiral that we're in is publicly to say growth, but internally a realization that a big part of it has to be inflation, and that we're going to have to control yields along the way. And so there was a paper I posted on Twitter that's recently released by the IMF. I'm not a big fan of the IMF, but basically it was an academic study looking at how did the U.S. get out of its 120% debt to GDP post World War II, and that a popular narrative has been through growth. But what they basically argue in this paper is that the bulk of the reduction in debt to GDP was caused by surprise inflation and distortion of interest rates. In other words, yield curve control. And so basically you suppressed real rates on bonds. And I think, part of the plan to do that is, even though Besson has said he does not want a lot of, short-term treasuries issued, I think that there's going to be a bit of a continuation of that Yellen policy. And there's going to be a big push for stable coins.
Well, just on that point, real quick, Yellen's policy took the repo market all the way down, and it almost left a sticky bomb for him when he's coming in, and he can't just deviate from her policy. He's got to adjust that short end of the curve. So I agree with you. She did, and they said recently they're having to do extraordinary measures. I think she was doing it, yield curve control extraordinary measures before they announced it.
Exactly.
And I think that he's going to have to react to that first before he can take his ideological, long end of the curve sort of argument forward. What are your thoughts on that?
Yes, exactly. I think, there is a number of bombs. There is money in the Treasury General account that he can tug at for a while. But I think it was around 700 or 800 billion, but that won't last forever. And you don't want to have no dry powder. You want to be able to at least have that there for, if yields did have a massive spike at some point for whatever reason, and you needed to go in and inject liquidity right away, having the ability to spend out of the TGA. So basically what that means is they can take money that already exists. They don't have to issue new debt. And then by not issuing new debt, they're depriving the market of issuance or what have you, helping to try to stabilize yields, inject liquidity. So basically it's a backdoor QE in a way. So I think that these issues are Besant. I think he has the mind to understand them all. He might not have understood them all when he initially made some of these comments about Yellen. And it's very easy to make these comments when you're not the decision maker. And then you get in and you realize, oh, there were reasons why she was doing what she was doing. She was holding this together like, with duct tape, and that
Duct tape and baling wire, like we say down here in Texas.
Exactly. And just rip off that duct tape and baling wire, the hay bales are going to start falling apart. That's for sure. So, back to the point, I was listening to an interview Larry Fink was doing at Davos yesterday. And he was really hyping up stable coins and the tokenization of cash and securities. And you're just seeing this massive push, which gives the levers of control for all of this, to the powers that be. And then on the other hand, I found this statement to be really interesting. It was the most interesting statement I heard from him. He said that the biggest problem facing the world today is that the world believes we've passed the high point in inflation. I mean, that's basically him saying we're going to have 10, 12% inflation because the high point was 9%. And that's a CPI reading, but other figures suggest it could have been as high as 18% at that time if you really calculated it the way we did back in 83. I think Larry Summers did that calculation. So if he's saying the biggest mistake the world is, and this is Larry Fink, I mean, this is a guy who's tied in deep state, trillions of dollars at BlackRock. He's saying the biggest problem in the world is we think we've passed the high point in inflation, and he could see real realities where inflation comes back in a sustained way. And that's almost a direct quote. I posted the video again on Twitter and the quote. I mean, to me, that's starting to prep the world that
Yep.
this inflation isn't over and it's coming back, and they're
Hmm.
going to begin to do, I think, a re-education campaign where they're going to start to attempt to convince people that this inflation is not going to be like Biden inflation. This is going to be inflation accompanied by real wage growth. That we're going to have sustained inflation that will be CPI prints of like 4 or 5, but in reality more like 7, 8%. But that wage growth, because we're going to make inroads on shutting the border, and I think we would have had real wage growth under Biden, except the border was wide open. So we're going to close the border and try to convince paycheck to paycheck Americans who have that high credit card debt that you mentioned that inflation is good for them. That
Hmm.
you're going to get
You're
your
inflating away their credit card debt, but through
inflate
wages. Yeah.
exactly, and in reality, they're also going to be inflating away the sovereign debt, and that this inflation is part of
Hmm.
the plan. And nothing convinces me more that I'm right about inflation becoming part of the plan more than Larry Fink saying, you know, it's coming. And so I think, and you see it, you see other, little sticky bombs that the Biden administration left, like
Hmm.
upping the sanctions on Russia, and you saw oil break
Hmm.
out of this multi-year downtrend,
Hmm.
going back to the start of the Ukraine war. So you're seeing in oil, even if you compare it to core CPI, ex food energy, like nothing tracks CPI like crude oil. I mean, you don't need to look at anything else. You can just basically look at a crude chart. And the last 6 months, oil's been in a tight, range in that $60 to $70 range until a few weeks ago when it really broke out. And so it usually happens on a lag. And so inflation reports for the next couple of months might not be that bad, and especially because, housing has been cooling off in rent. And so there's all these kinds of, idiosyncrasies of the CPI report that might not show these big prints right away. But I think people will start to feel it. All of a sudden, that energy inflation will start to kick in, and they'll start noticing, hey, my eggs are higher. Hey, with the grocery bill that was stabilized or even going down a little bit in recent months, it's back on that uptrend. And so this inflation, I think, is coming, and that's really going to drive yields. And then, you get into the yields going up, and then what the problem there is you have not only the government, spending to service that debt, and there's a lot to roll over, but in a weird way, the large interest payments are almost like a stimulus injection, because they're going to bondholders, which are pension funds and banks and wealthy retirees that can still get 4 or 5% on their cash and their money market accounts. And so that feeds into it. It starts that spiral, and then you get wages going up, and you get these spirals, and then, in World War II, they put in price controls. I don't know if we are going to go eventually to price controls, but that was part of the game plan back then, and I don't think you can take that off of the table either.
Do you think ultimately all those moves will be successful? And one of the reasons I ask, I was at lunch with a friend yesterday, or having some barbecue, and just chit chatting. And he's getting to retirement age. He's like, is Social Security going to be there for me, Rob? And I said, I think it'll be there, but I think they're going to, and I don't think that necessarily they're going to want to cut Social Security benefits. Because if you do, you affect the seniors being able to live, because we have 40, 50 million people depending on those benefits to live, to literally pay for things. But I said, what they may do is just inflate the value of the dollar. Now, their Social Security benefits may go less far, but I think that they're going to inflate it. But how does this affect people on fixed incomes? And does something break along the way here? If you're going to go to price controls, which a lot of times creates supply destruction, and you're going to go to increasing the amount of dollars in the system, inflating that away, a little bit of easing, a little bit of dollar printing. Does this system break in some way? Does it break for people on fixed incomes? Does the inflation of prices outrun wage inflation? Does the supply destruction on goods cause us some issues there as well? I mean, is this going to end well, I guess is what I'm asking about.
Well, I guess, there was a famous article, "The End of History." I think Fukuyama, I probably butchered his name there, wrote it, years ago, basically at the peak of like kind of U.S. dominance, and I think, I don't think there's a need to be sensationalist about it. Like these are things that just happen. Maybe they're not fresh in our memories, but Nixon talked about price controls, and we had inflation spirals for pretty much all the 70s and 80s. We had massive inflation in the 40s after World War II. So I mean, and, my dad was born in 1939. So even in the lifetime of my father, these types of things have happened twice already. I mean, why can't they happen a third time? And yet we did get through them. And so I do think at the end of the day, you get through these situations, but I do think that there are winners and losers and pain along the way. And that's not going to go away. So you mentioned Social Security, and exactly, that's one of the main reasons why they manipulate CPI so much, is because of the cost of living adjustments. The other main reason is that every year, you might not realize this, but I mean, you probably do, but some people might not, marginal tax brackets get changed based on CPI. And so, they don't want CPI to go up and then you stay in those lower tax brackets. So
Right.
both income tax, cost of, so on the payment side, the outlay side, Social Security, and on the receipt side, the income side, tax receipts are all tied to CPI in a huge way. And even like a tenth of CPI translates into billions of dollars for the Treasury when you combine those. And so you can imagine how important it is that they can show a print of 2.8 when it's really 3.8, the hundreds of billions of dollars, because it also compounds. So it really turns into trillions of dollars. And so CPI is a completely manufactured number, obviously. So I do think that what's going to happen is, people that are on these fixed incomes are going to notice, oh my gosh, I used to, and you're seeing it. You're seeing the rise in homelessness. You're seeing, on YouTube, some of these popular channels of like van life or RV life. And a lot of it is seniors, that it's not like hippies or people going out to live in the middle of the desert in an RV. It's people that are 70 years old, and they have Medicare and they have Social Security of like $1,500, $2,000 a month. And they're like, I cannot live in a city anymore in an apartment. I can live in an RV and I can see the world, and it's not ideal, especially as you get older. Walking and doing physical things gets more and more difficult. But you're seeing Americans turn to these kind of resources in order to just survive. And so I think that's going to continue. But I think part of it with the inflation is it will actually also inflate the stock market. So this also gets into seniors, the more wealthy spectrum of boomers, who their whole lifestyle depends on a good S&P 500.
401ks, pensions, that type of thing.
Exactly. And so once we nationalize the stock market, it went from the preserve of a wealthy elite, where it could crash 50%, and maybe that wasn't good for banks, and the billionaires lost some money, to now it's the national pension system. And so it becomes a matter of national security again for the S&P 500. There's a Fed put. I think there's a bigger one. It's called the Treasury put, the government put, that the United States government will not allow the S&P 500 to significantly tank and stay tanked for long, because not only does it bankrupt the kind of piggy bank of boomers, but it also bankrupts the United States government, because so much of our tax receipts are dependent on it from capital gains. So again, I think this is just more like, so I think that as these crises unfold, we're going to see a period this year, probably sometime in the second quarter, but timing these things is nearly impossible, but where some of these issues start to come to a head, where maybe yields and get a little bit too strong, too high. And it's going to result in, I think, a 10 to 30% drawdown. The midpoint of that, let's call it a 20%. So a more significant drawdown than we recently saw in January this year, which was about 8%, I think, from the intraday high to the intraday low. Something, at least twice that much, at least 15, 20%. And it's going to then begin that process of Treasury needing to come in and inject liquidity, discussions of this new Bretton Woods that Scott Bessent wants to do. And you're going to start to see, I think, a lot of jabbering at the Federal Reserve to cut interest rates, regardless of the worries of inflation, because domestically we need it. And then foreign wise, we also need it, because there are problems in Europe, and they're on cutting, they're clearly in cutting mode. UK unemployment is rising. Europe is a basket case in many ways. And so that interest
Productivity
rate,
is down in a lot of
yeah,
ways. Mhm.
yeah, the interest rate differential can't continue, and you can't tell Europe to raise rates because they'll go into a depression. And so basically the only answer is for the US to cut rates to control the dollar. And I think we're gonna see it. It might not be overt. This is yield curve control and on the long end, and we're going back to ZIRP on the short end. But it might be like, with rising inflation, the Fed continues to cut, and everybody at CNBC is like, why is the Fed cutting? Inflation is actually on the uptrend, and you'll have people, like Powell coming out and giving reasons like stability of the bond market, or pulling at straws, trying to find some weakness in the data that they can say we're trying to get ahead of the curve. And if he doesn't do that, you're going to have, Bessent and Trump jawboning that they should be, maybe even doing what Bessent suggested of a shadow Federal Reserve. And then, no doubt, by the time spring of 2026 comes around, Trump is going to put someone in there. We know he wants loyalists in every key position. He's going to put someone in there who's going to be willing to sacrifice Federal Reserve independence. And he doesn't need Congress to repass a new law. He can insert a Fed chair who's going to play ball with all these things that he wants to see happen. And that's why I think ultimately we probably end the year up on the stock market after this, 15-25% decline.
All right, good thoughts. And any last thoughts first as we wrap this one up? What happened? We talked about that you see is important that people should be aware of for 2025.
Well, I do think commodities have really sent a message lately. Copper's at some key levels right now. You see the AI infrastructure, the power structure. I think it's no surprise that along with the banks, industrials have been the best performers of 2025 so far. And so I do think that we're going to see, I'm not sure what the NASDAQ's going to do, but I do think that we're going to see a little bit more of a broadening out when we do rally from this correction or pullback, where it's not just all Mag 7 and AI type names. It's going to be, the Caterpillars of the world, the Freeport McMorans. And I do think gold, I love gold. I think it closed above 2720 recently. It's broken out of a downward wedge. It seems to be wanting to go attack new highs. And I think that gold, as well as Bitcoin, actually will do extremely well. Industrials and that, be prepared for volatility and a pullback. Me personally, I've raised a good amount of cash, anticipating buying opportunities at some point in the next 3 to 6 months.
Awesome, great. Thank you so much, Mel, for coming on. I know it's been too long. We'll definitely have you on again as events change or unfold this year. I think there's going to be a lot of things happen this year that are going to surprise people. I've said I think this is going to be the year of surprises. I think you probably agree with that. Big changes coming. So we'll definitely bring you back on to offer additional insights. And we thank you for jumping on the program again.
Thank you for having me. My pleasure.
Yeah.